So on behalf of MK Global, I am pleased to welcome you all to the Q3 FY24 post-earnings conference call of Gulf Oil Lubricants India Limited. The company is represented by top management, Mr. Ravi Chawla, MD and CEO, and Mr. Manish Kumar Gangwal, CFO. So today's session would be a brief on the results, followed by the question and answer round. So without any further delay, now I would like to hand it over to Mr. Chawla. Over to you, sir.
Thank you, Sabri. Good afternoon and good evening, ladies and gentlemen. Welcome to the Quarter 3 earnings call for Lubricants India Limited. I'm happy to share with you that, this quarter again we have continued the positive momentum to achieve a 29% growth in PAT. And also another milestone for us is the highest ever EBITDA of 111 crores. As we say in cricket, this is a back-to-back centuries. Last quarter also we had crossed 100 and we are very happy to add one more one. So 111 crores is EBITDA for this quarter. Sequentially also we have improved our margins despite increased A&P investments which have been quite good in this quarter. We're happy to do that. And of course, when you look at the whole milestone we reach, I think the team and of course our trade partners and all the other customers really delivered an excellent December quarter and further strengthening our position for 9 months. And if you see 9 months, we are ahead of the industry in terms of all parameters, most of the key parameters, which is from April to December. Again, reinforcing our dedication to continuous growth and operational excellence. The success that we've had obviously spans across various categories. We've looked at our robust distribution, brand initiatives, and our focus remains on strategic, sustainable, and profitable growth across our portfolio. We also, as I mentioned to you, saw significant elevation in brand investments with activations like India Bike Week. We have participated in the CRS Exxon exhibition, new TVC, new campaigns with our brand ambassadors, obviously to amplify our brand awareness levels, increase market share. So really happy that all this has happened. Our core volume growth for the quarter, lubes volume for the quarter was 36,000 KL with a 5.8% growth over last year quarter, which is 2x of the industry. And definitely we saw good double-digit growth in infrastructure, B2B. We also saw retail volume channels showing growth in agriculture and motorcycle products with double-digit growth. I think all this helped us to achieve a good quarter.
Hello, sir. Sorry to interrupt, sir. Your voice is not clear, sir. Can you... It's muffled.
Is this better now? Is this better?
Yes, sir. Yes, better.
Okay. So we focused also on, obviously the core lubes volume for the quarter was 36,000 KL with a growth of 5.8% over last year, which is 2x of the industry. And majorly due to double-digit growth in infra, B2B segments, and agri and motorcycle products. Our product mix also, we focused on premiumization and profitable business in segments like OEM, industrial, B2B. Obviously, we are seeing demand for high-quality products, but also looking at the value range, which is also doing well for us. New customer acquisitions in infrastructure, and we have seen, again, channel retail, that passenger car also picked up along with agri. And all this has helped us, and the B2B segment again has given us very good growth. OEM again, good focused growth. So overall, I think a very good quarter. Just to talk a bit about India Bike Week. India Bike Week is targeting premium bike owners, and we have a brand called Gulf Track. This is really one of our key brands which is going to help us grow. And we've introduced a page called Ride with Gulf, where we have seen our engagement, social media with all these passionate motorcycle riding communities is going very well. We've had rides across 20 cities called Chai Pakoda rides. Definitely all this is going well for our growth. In addition to this, I'd like to mention on sustainability, we've enhanced our solar power capacity in both the plants and we're looking at further enhancement there. I was looking at sustainable packaging solutions. And in our CI exhibition, XCon, we showcased our innovative products like biodegradable hydraulic oils. We also want to showcase our EV charging solutions, which we have invested in a company called Tyrex DC Chargers and Electrify. So this also got a lot of attention, and I think this has been a good quarter. I now hand over to Manish to cover some of the other highlights of the company and of the finances. Over to you, Manish.
Thanks, Ravi. Good afternoon, everyone. So as Ravi mentioned, this has been one more good quarter for us in terms of overall all parameters. And our growth momentum continued what was picked up in September quarter. This quarter has been the highest ever revenue of 817 crores, highest ever EBITDA of 111 crore, and highest ever PAT of nearly 80.75 crores. So, and with a quarterly EPS of 16.46, this is a all-time high quarter in terms of PAT and EPS. At the same time, the margin management has been the key focus for the company, and we see the result of that. Our gross margins have improved by nearly 5.6% on YOY basis over last year December quarter, and that's a significant improvement of 5.6%. A part of it we have invested back, like our A&P cost has, we have invested more in the brand during the quarter by nearly a percentage point, and we have been able to improve our EBITDA also by nearly 200 basis point on YOY basis. And also, this quarter, considering that the performance has been good, the board was confident enough to announce an interim dividend of rupees 16 per share, which is 800% of the face value of rupees 2. And obviously, on the back of a last year rupees 25 full year dividend, 16 rupees is the interim dividend which has been announced by the board. We continue to maintain a healthy cash balance. At the end of 31st December, as on 31st December, we continue to carry close to 700 crore of cash, gross cash, and the net cash is nearly 320 crores. This is after the payment of final dividend in October and investment in Tyrex, which was 102 crore, as you all know. So overall, in spite of these investments and routine capex, we have been able to continue to maintain a healthy cash balance and generate overall good cash from the operations. Overall, we have also during the quarter on 30th of October completed that Tyrex acquisition, and going forward, we would definitely, this is strategic move in the EV charging segment with Indra technology for slow chargers and Tyrex for fast chargers. Overall, we see that this business segment will continue to deliver or continue to be contributing substantial in the coming years as the market we see will keep maturing on the EV side over a period of time. So these businesses are in the line of, these investments are in the line of future businesses. So overall, on all fronts, I would say a healthy quarter, a strong quarter from us, and we would be happy to take questions now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephones. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Probal Singh from ICICI Securities. Please go ahead, sir.
Thank you very much for the opportunity, sir. Congratulations on a strong set of numbers. First question that I had, am I audible, sir?
Yeah, your voice is slightly breaking, but please go.
I will try to be louder. Sir, first question, if I look at your EBITDA margins, you did mention about the improvement that has happened. Just wanted to understand, our EBITDA margins have now hit a 7-quarter high from what I can see of 13.6%. I think the last time they exceeded 13% was way back in Q4 of FY22. So one, if you can kindly, sort of give some broad factors on what has driven this margin improvement and what sort of guidance should we take from this for maybe the next couple of years in terms of how this margin will actually go. That was my first question.
Yeah, so thank you, Mr. Sen. Basically, as you have rightly picked up, 13.6% EBITDA margin for the quarter is the highest among the last many quarters. And we have seen and we have been guiding about it that, we are going to see sequential improvement in margins as we move forward, and that has been our guidance for the last 2-3 quarters, and we have been trying to deliver that. Key factors, I would say, is that there have been a stable input cost. And, a year ago, you will all remember, the participants will remember that there has been an inflationary environment across categories and especially in the lubricant sector where base oil had rallied significantly on the back of crude rally, and at the same time other input costs like additives, etc. have also increased. We had to pass on significant cost increases to the end consumer customers, and that has resulted in a significant increase in the top line. And we have been also mentioning that whenever there is a stability in the input cost, when it comes back, typically some margin tension happens. We have to pass on some of the cost improvements back to the consumer for the benefit of them, but in the process there is some retention which happens. So that has been one reason. We have been continuously also working on product mix improvement and premium products, high margin products, synthetic products. So that has been our continuous focus. All the business segments within the company have been prioritizing or pushing in terms of improvement in the product mix. That's also one of the key factors or driving factor. And third, of course, is also the operating leverage. So as we keep growing our top line and volumes, we get that operating leverage of spreading the fixed cost over a larger volume or revenue base. And I would say a combined effect of all these 2-3 points have been that our margins are seeing a continuous upward trend.
Right. Just to reiterate the second part of my question, in terms of guidance, is it fair to assume that, given that crude seems to be operating in a narrow range, and therefore base oil prices might not also see too much of escalation from here, can we then build in some more of margin expansion from here over the next 12 to 18 months?
So it's a continuous effort, Mr. Sen, to keep working on the margin. We have been initially guiding about a 12 to 14% margin band, and we are on the upper trajectory of that band now. And as I mentioned, our work on premiumization, our work is on getting that operating leverage also. So our twin focus of growing the volume and at the same time keeping a margin band intact and slowly improving to the next band of margins is an ongoing effort. So while we do not give a specific guidance as such, but overall, yes, we are looking for a margin trajectory which is going to be, continuous upward trend is our objective.
If I may add, you see, it will also depend on the mix of products that we sell in terms of our various segments, because we are a company which has got our retail business called Bazaar. We also have...
Hello, sir. Sorry to interrupt, sir. Your voice is not clear, sir.
Okay, no problem. I think Manish can make the point. Manish, you can talk about mix and also how we have got...
I will disconnect your line and connect you again.
Okay, do that.
Sir, okay.
So while Ravi rejoins, Mr. Sen, basically what we are trying to say is that we operate in different segments of the market. As he was talking about the retail segment, and then we have a large OEM related segment as well, and plus the B2B segment where we operate infrastructure customer, industrial customers. So our objective is to continue to grow volumes across all these segments, sub-segments, and still keep working on delivering or improving our set of margin band. And so the 12 to 14%, as we said, we are currently in this band. Obviously, going forward, we would like to move to the next band at the opportunities whenever we have. But our focus will also be to continue to grow 2 to 3x the industry in terms of revenues. So that has been also our key priority, and we want to continue that as well.
Understood. Sir, I have just had one more question, and Chawla sir did mention in his briefing. Unfortunately, the audio was not clear. If I can please get the volumes of lubricants and AdBlue for the quarter.
So the core lubricant volume for the quarter has been 36,000 KL.
36,000, okay.
36,000 KL.
Right.
And the AdBlue volume has been 31,000 KL. So the total volume for the quarter is 67,000 KL.
Understood. And lastly, sir, just in terms of the acquisition of Tyrex that was completed, in your estimation, when can we actually see these the electric, the EV portion of our business actually starting to become material in terms of overall revenue? And I'm asking a very broad question, I realize. I mean, from a business mix perspective, is it fair to say that it's probably still 2 years away before these, businesses actually start to show up as a material part of our revenue? The electric charging business, the battery, swapping part of it, and so on.
See, what we are seeing currently is that in certain segments of the vehicle categories, the penetration of EV will be sooner than many of the other categories. So it is actually going to be dependent on many factors, including how much is the government also going to push or give incentives in terms of, pushing the categories of EVs. But, the question is right now, it is about chicken and egg, I would say, whether there should be a charging infra created first for the vehicle owners to be propelled towards EV buying, or it is going to be a sizable EV population for the charging infrastructure companies to, put up to get some ROI on the investments which they make. So it's a very difficult situation, but in terms of overall trajectory, there will be, an EV penetration in certain segments, like, for example, e-buses, where definitely there is going to be a good movement, and most of the fast chargers which Tyrex is making are going to be towards those segments which are requiring high capacity charging, like fast charging or DC charging with, 240 kilowatt chargers like that. So obviously that categories are going to be, prioritized first. And we have recently heard an announcement from government that out of 24 lakh government buses, 8 lakh buses are going to be converted to EV by 2030. So these are the kind of initiatives where you will require this fast charging infra to be there. And that's where Tyrex prime focus is, and that's a prime category and target market. So obviously we are quite hopeful of this business. Also at the same time, the slow charging business of products also is going to be relevant for certain categories like two-wheeler, etc., or car. So overall, we see good potential, but when that can be that tipping point is something it's dependent on many factors.
Understood, sir. Thank you so much.
You hear me?
Yes, sorry, sir. Go ahead.
Yeah. So, there are 4 segments. As Manish said, there is the bus OEMs, then the public sector, the fuel stations are also putting chargers. There is the charge point operators, and then there is the retail. So, as we have said when we had, partnered with Tyrex, we look at these segments and definitely it's going to take off, we feel, as soon as adoption goes up. So it will, when you say substantial revenue, when you look at the market, they are 8-10% market share today. If they continue delivering on the market share, and of course we hope to improving on the products and technology, we should be able to become a 8-10% player in the DC charger business. Plus, there is a potential to export this charger once we get the product, approval. So I think it's got a good sort of uptick once the market starts responding. It could become material, as you said rightly, in a few years' time.
Understood, sir. Thank you so much for the detailed answers. I'll come back if I have more questions. All the best.
Thank you. Ladies and gentlemen, please limit your question to one per participant. Should have a follow-up question, we request you to rejoin the queue. Our next question is from the line of S. Ramesh from Nimal Bang Equities. Please go ahead.
Good afternoon, and thank you very much. So if you look at your consolidated numbers, you have given the details of the Tyrex acquisition. So is the capital employed in the Tyrex subsidiary 146 crores? And is that the gross number which we should look at?
Yes, so we have invested 102 crores from the company for a 51% stake.
Yeah, so I'm just trying to look at that business. You're given the working for the goodwill and the adjustment. So there is there are 146 crores is the net identifiable asset acquired. So your what is the underlying capital employed for which you have paid 102 crores, just to understand the size of the company?
Yeah, so 146 crores.
146 crores is the correct number. So when you're looking at the, business plan to achieve a certain ROCE, that is the number on which you have to earn a certain ROCE, right?
Right.
Okay. So you just to get things in perspective before I go to the main business, what is the additional capital expenditure you will need to do, say, over the next 2 to 3 years to scale up and achieve, say, a certain commercial scale and break even in the Tyrex?
So out of our investment, 65 crore rupees, as we have highlighted in our earlier calls also, 65 crore rupees has gone in as primary investment into the company. So they are fully funded for the next 2-3 years of their capital requirements. And by the time, I think they will be self-sustainable in terms of, cash flow generation.
Okay. So now in the main business, in terms of the overall, segment mix, how much is auto now and what is the infrastructure and other segments, if I may ask?
So overall, our mix has more or less remained the same as per the earlier quarters. There is slight improvement in the B2C section in this quarter. So B2C for the quarter was around 58 versus B2B 42, while it was 56-44 in the previous quarter.
Okay. And in terms of the other expenditure, can you give us a breakup in terms of how much is the advertising and sales promotion expense? Since you said you're stepping that up, so what percentage of your revenue has been spent on third quarter, 9 months, and how do you see this moving over the next 1 or 2 years?
So we have spent a percentage more in this quarter, as I mentioned in my opening remarks, and the percentage of A&P to revenue in this quarter was close to 4% as compared to our usual 3% on a full year basis if you take a 9-month basis.
Okay. So in terms of your overall volume growth in aspiration, what is the kind of volume growth you can achieve, say, FY2025-26, assuming the kind of stable oil and base oil prices?
As we have been also highlighting that our guidance and objective has been to grow 2 to 3x the market growth rate, which we have been delivering over the last 10-12 years, and even in the current year we have been able to do that. Our 9-month revenue has grown by 10% already. And if we take the lube industry, the usual volume growth is, let's say, 3% on an average. And the value growth, of course, is higher than that, almost sometimes double of that. But we have been able to deliver 6% volume growth in this quarter. And, one of the business segment for us is factory fill business, where we supply lubricants when the vehicle leaves the factory for the first time. And a large part of that is relating to commercial vehicle for us. We have seen that there is some slowdown in that commercial vehicle segment sales during this quarter. They have been doing extremely well till September, October. So there have been some slowdown, and because of that, there is some impact in our factory fill volumes in this quarter. And if we exclude factory fill, other businesses have grown overall 8% instead of 6% combined. So that is one point I wanted to make it clear, that this 36,000 KL volume could have been even better if the factory fill would have continued at the same pace. Our overall guidance also for future years is that we will continue to grow 2 to 3x the industry growth rate.
Okay, thank you very much. I will join the queue.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask question. Our next question is from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Sir, what is your 9-month volume and the volume growth rate?
Overall, for the 9-month period, our core lubricant volume is 105,000 KL.
And what is the volume growth rate, sir?
And the overall volume growth rate is nearly 5%.
Okay. So any reason why for the year we haven't not grown more than 2 or 3 times the industry growth rate so far?
So we believe that the industry is growing at, in this year, the 9-month period, if we take overall, the industry would have grown 2 to 3%. And we have grown 2x nearly. One of the reasons there is some impact is also, as I mentioned in my previous question, because some of the factory fill businesses are slightly negative, especially in this quarter. So that has resulted in some slowdown. But overall, our trajectory of delivering 2 to 3x continues. On the revenue side, we have already done 10% YTD growth.
And you mentioned that factory fill business in this quarter declined, or is that what you mentioned?
Yes.
Okay. And can you just give some broader idea how much is factory fill business for us and how much is the bazaar business?
So factory fill is roughly 10%. 90% of our business is replacement market, whether it is through bazaar or through OEM franchisee workshop or through the industries. But direct factory fill business is close to 10%.
Okay. And the base oil price average for us for the 9 months should be what?
So it is actually, there are various categories of base oil at different price levels. Group 1, Group 2, Group 3 base oil, each has their different price levels. On an average, I would say that base oil has been steady for the quarter across all categories, except that some of the refiners, especially of Group 1, have taken some sort of a shutdown for maintenance shutdowns and all. So Group 1 prices have slightly gone up. But overall, as a trend, base oil follows crude and with a lag of 1 to 2 months. And, crude has been stable to slightly lower in terms of trajectory, what it was in July, August or September, and also even up to October post-Israel conflict. So overall, we are seeing a downward to stable trajectory in crude oil, which augurs well for base oil as well. And we see stable input cost going forward.
Okay. Thank you, sir.
Thank you.
Thank you. Our next question is from the line of Arko Pratampal from Sanjay Agrawal Broking. Please go ahead.
Good evening. Good afternoon, gentlemen. Am I audible?
Yes.
Okay, sir. My first question is, what is your expectation of volume and sales growth on quarterly and year-on-year basis?
So I've just replied that in the previous question, sir. We will continue to grow 2 to 3x the industry growth rate. Industry, we assume, is going at 3% on an average in terms of volume, and in terms of value, it is higher, let's say 5 to 6%. And we continue to deliver 2 to 3x. And that's what our objective has been, to continue to deliver 2 to 3x the overall industry growth rate.
Okay, sir. My next question is about what is your expectation demand scenario in current environment of the market in your company?
Sorry, your voice is not very clear.
I'm talking about what is your expectation demand scenario in current environment of the market?
In terms of cost or volume?
Cost and volume both. Can explain.
So as I mentioned just now, we expect the lubricant market to remain robust. And when we say robust, it is a 2 to 3% growth, 3%, and in some good quarters it can be even slightly more. So overall, we see a good traction happening on the vehicles side. India is a under-penetrated country in terms of vehicles per capita. Infrastructure segment, the significant investments which are happening and going to happen are going to continue to push the sales of commercial vehicle and other related movement of goods and services. And GDP is going to continue to grow at 6 to 7% as is estimated. So overall, all these factors augur very well for lubricant growth. And I would say we are in a situation where we see continuous growth in the lubricant segment, at least with 3% volume growth annualized.
Okay. Thank you, sir. Thank you for the answer.
Thank you. Our next question is from the line of Pinaki Banerjee from AUM Capital. Please go ahead.
Thank you, sir, for the opportunity. Sir, just one question. Sir, apart from the AG segment, as we know, the Indian government is now focusing on that ethanol blending or 20% ethanol blending target in petrol by 2025-26. and also addressing the automakers to come out with flex fuels. As we know that Toyota and Maruti are the two automakers which have already made some important strides in this coming out with this flex fuel. So actually, have you made any special R&D with regard to this in this segment?
So yeah, first of all, I would like to clarify that ethanol blended fuel and engines which cater to that require similar kind of and same lubricant and in terms of quantity. So there is no change in demand due to the mixing of ethanol or anything. The demand is going to remain similar because the engine performance is accordingly tweaked and lubricants are required there as well in same quantity. Okay. In terms of change in the formulations to cater to those engines, we are ready with all the products as and when, because we work very closely with OEMs in terms of engine technology and with our additive suppliers. So obviously, as and when the requirement will be there, we will be ready with all the products.
Okay, fine. That's all from me.
Yeah, just to add.
Okay, please.
Can you hear me, Manish?
Yes, please carry on.
Yeah, go ahead.
Yeah. We have a global R&D center of Gulf in Chennai, sir, and this is continuously developing products to meet all these kinds of requirements, as you said. So we are fully prepared for that, sir. Just to assure you. Yeah?
Okay, fine. That's all from me. Thanks, and all the best.
Thank you. Our next question is from the line of Nitin Tiwari from Phillip Capital. Please go ahead.
Good evening, sir. Thanks for taking my question. Sir, just if you can help us understand our capacity utilization at this juncture, and are we planning any investment in capacity to meet the need for our growth in volumes down the line?
So, thanks, Nitin. I think we are almost now 99%, 100% utilized in terms of capacity. Overall, if we take both plant blended in terms of blending, but this is on 2-shift basis. So we'll continue to keep augmenting the third shift in terms of our volume growth requirement. And our capex guidance of 20-25 crore rupees annualized is towards more filling lines and storage capacities to be enhanced in line with the volume requirement. And with those capex of 20-25 crore rupees for the next 2-3 years, I think we can sustain our volume growth of 2 to 3x. And thereafter, we'll have to see how to further, build the capacity. Overall, blending-wise, I think we have enough capacity for next 3 years at least.
Understood. Thanks for answering. I'll get back in. Thank you.
Thanks.
Thank you. Our next question is from the line of Chirag from Ratnara Capital. Please go ahead.
Hi, good afternoon, Manishji, Raviji. If I'm audible, thank you for the time. Just one quick bookkeeping question. What was the battery sales for the quarter?
Yeah, just a second. So battery sales for the quarter was nearly 17 crore rupees. Sorry, 19 crore rupees.
Understood, sir. Understood. So, two quick questions, sir. Then, given these, probably our realization in the core volumes has trended down by around 4% quarter on quarter and more than 7% year on year. Is that broadly in the right horizon? Are our realizations a little bit, given that input costs have stabilized and come down, have the realization as a mix or a percent or just price realization come down by around that quantum?
You see, as I mentioned in my opening remarks also, that whenever there is a stable input cost after hitting a multiple year high sort of input cost levels, when it comes down, we have to obviously pass on some of those to the end customer consumers. Of course, while doing that, we end up retaining always the margins to some extent. But obviously there is some pass on which happens for scheme recalibration usually happens in retail market, and the OEM businesses are also price variation clauses are there for quarterly pass on or pass back. So obviously to that extent, when there is a softness, there is some downward trend in the realization, but that is usually less than the input cost per liter downward trend, and hence we end up retaining margins.
I understand. Just my question is, the quantum of that would be close to 4 to 7%, depending on how you look at it, around in that range?
You see, that is because of the several mix also. There is an AdBlue which comes into play, AdBlue sales, which is going as a percentage of the overall kitty. And then there are segments within that, suppose the industrial segment, which is relatively lower than your retail segment. So all those factors play in, but I am giving you a general trend that how the industry operates.
Understood. Thank you. The second question is, in the last 9 months, we have probably spent around 95 to 100 crores on advertising. Is that so? It's been 4% for the last 3 quarters, right? Is that correct?
So we usually give percentage. So close to 3% has been our 9 months utilization, 3.5%. This quarter was a percentage higher.
Okay, understood, sir. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask question. Our next question is from the line of Hemal from an individual investor. Please go ahead.
So, congratulations on good set of numbers, and thank you for taking my question. Just one quick one on the net working capital days. Can you say, are we seeing improvement out there, or what did we end up with in end of December?
Yeah, thanks, Hemal. I think our working capital remains similar to the last quarter when we answered the same question. It is in the range of 110 to 115 days on gross basis.
And before this year, do you see significant improvement out there, or do you believe it will be in the same vicinity?
You see, with our revenues growing by 10% and overall input cost also stable, we don't see major changes. But at the same time, inventory-wise, we have been slightly better off, because as the situation of global demand, supply and supply chain especially improved. Of course, now we are seeing some Red Sea crisis and all. We have to see how much that impacts. But trajectory of our inventories have been slightly improved in terms of number of days, while the receivable continues to be at the similar level. So some marginal improvement going forward, but not very significant changes we see.
Okay, and my final is, have we seen that you sell through e-commerce also, right? Like, is that a very small percentage of revenue? I'm assuming it's small, but is it extremely small?
Ravi, you want to take that?
I'm sorry, I can't hear you. Hello.
No, so Ravi, you are not audible.
Line from Ravi sir has been disconnected. Wait, I will connect him.
No. So I will take that. E-commerce is a very, very small percentage, negligible as of now in this industry or for us as well.
Okay. Thank you, sir. I think that's all from me.
The concept of do-it-yourself is still not there in India. We usually go to mechanics and to the nearby garages to get our servicing done. So the e-commerce is yet to pick up. While we are present on all the marketplaces in terms of our product presence, but the offtake is very negligible.
Thank you, sir.
Hello?
Yes. Hello.
Yeah, take the next question, please.
Okay, sir. Thank you. Our next question is from the line of Prashant from ISJ Securities. Please go ahead.
Hello.
Yeah.
Hello. Thank you for the opportunity, sir. My first question is, what is the revenue contribution from lubricant business, battery business, and charging business?
So right now our most revenues are from lubricant business only, and battery business has contributed close to 19 crore as I mentioned.
Okay, sir. Can you tell me the margins in the lubricant business and battery business and charging business, what is the EBITDA margin?
While we do not give breakup, charging business is yet to take off. There are no meaningful revenues to be discussed. And the battery business is more or less at this moment EBITDA neutral. So the margin contribution comes from lubricant business mostly.
Oh. Okay, sir. And hello. What are the revenue targets specifically for AC and DC charger segment over the next 2 or 3 years?
I think Mr. Ravi answered this question in one of the earlier questions, and I also added there that this is a very nascent segment. It is growing it is expected to grow rapidly as the government has a lot of plans to, put charging infrastructure across the territory. In the recent budget also, Honorable Finance Minister has mentioned clearly about the charging infra and government push towards that and investment towards that in her speech. So the sector is going to be, having a very fast growth in the coming years. Since it is a very nascent one and depends on many factors, including government push, it's difficult to give a number. But Ravi did mention that, this direct company is 8 to 10% currently in terms of market share. The fast charger market is expected to be more than 10 to 12,000 crore by FY2030. And if directs can continue to maintain their share of 8 to 10%, you can do the math of, the kind of potential it has.
Okay. Thank you, sir.
Thank you.
Thank you. Our next question is from the line of R. Ramesh from Nimal Bang Equities. Please go ahead.
Yeah, good evening. Thank you for the follow-up. So if you look at your consolidated numbers, there is a loss of 65 lakhs. So is this part of the Tyrex P&L? Where does it come from?
Yeah. Since we have started consolidating now.
Okay. And that share of JVs is from the other two entities, right? So there's a 4 lakh and the loss of 25 lakhs in 9 months.
That is from Electrify, a company Tech Prospect, Private Limited. They are a SaaS provider, which is software as a service provider to EV charger and vehicle companies, OEMs. And since we have only 26% stake there, that's a share of associate. In another company called Indra Technology, which is UK-based, we do not consolidate as we only hold 7% stake there.
Okay. So this minority interest loss in Tyrex, if I may ask, is it just the normal loss as a result of the accounting, or do you see some operating loss, say, in the next few quarters? How do you think the P&L will move in terms of the consolidated numbers?
You see, they are investing significantly in terms of technology, in terms of resources, in terms of manpower. So obviously, while it's not going to be a very significant cash burn, but we expect there's some sort of stability to come to them in terms of EBITDA numbers in 3 to 4 quarters from now when they reach a sizable turnover. So for the next 2-3 quarters, there will be some minor negative EBITDA, not something very significant.
That's useful. So finally, when you talk about this ability to grow 3x industry, how do you explain this, and what are the factors which are helping you do that? Because HVCL is talking about hiving off their lube business. There is Castrol, which is trying to regain market share. So how are you able? Because basically you are saying that you will keep increasing market share. So is it your pricing? Is it your brand? What is actually driving that growth rate compared to the industry?
Ravi, are you there on the line?
Yeah, I'll take it.
Yeah.
Just to explain to you, 15 years ago, we were number 6 or 7 in the private sector. Now we are number 2 in the private sector. We have taken a strategy. We are not really that big. We have good market share in motorcycle and commercial vehicle oils and with OEMs. But we've grown our business with a 5-pronged strategy. One is to look at a segment-wise growth. Whichever segments we think we can win, we have grown, like motorcycle, commercial vehicle. We've built our brand up to be the top 2. We have brand through cricket,
things. We have increased our distribution. We also looked at other segments in B2B like infrastructure, industrial, OEMs. We had only a couple of OEMs in 2007. Now we have more than 40 OEMs. So this strategy is what has made us win 2 to 3x. So these 5 things I told you now, and of course, our team is more passionate, and we do a lot of above the line, below the line. So building our brand, going segment-wise, and more importantly, also leveraging our technology. We have had long-drain products. We have the longest drain product in tractor now. We also had created long drains in the commercial vehicle segment. Our products are very high quality with Group 2, Group 3. So this is the 6 strategies which has helped us to grow. And we still believe some segments we are below 5% market share, we can grow more than 2 to 3x the market. But overall, we give a guidance of 2 to 3x of the market growth, which we have done successfully for the last 10 to 12 years consistently. And we believe still there is enough headroom for us to use our brand, increase our distribution, increase our sales, and of course now look at other things which we are also looking at strategically.
If I might ask, in terms of your management's aspiration, where is your market share target, say, in the next 3 to 5 years?
Yeah. So you see, we have gone from number 6, number 7 to number 2. Then obviously there was an aspiration, right, to make it. So we have reached the second position. Now the aspiration is to grow 2 to 3x and definitely increase our market share in the passenger car segment, grow 2 to 3x all across. So we have a very strong brand. So the aspiration still is to look at 2 to 3x the market growth in the segments that we are present.
Thank you very much and wish you all the best.
Thank you.
Thank you. Our next question is from the line of Nikunj Doshi from Bay Capital. Please go ahead.
Yeah, hi. Good evening. I just wanted to understand what is scope of premiumization in your business and how would you classify it and what percentage would you say is from premium products right now?
Yeah, so broadly, can you hear me? Sorry, I'm on.
Ravi. You're audible.
Yeah.
You're audible.
Yeah. So, sir, premiumization is, looking at the synthetics, which are low single digit for us. So really across motorcycle, car, and definitely looking at those segments. The other is the products which give us a better margin. That is premiumization. So even in the B2B segment, OEM segments, there are certain products which give us a better margin. So the shift is to at least try to grow that in our portfolio, which are also long-term solutions, better solutions for the consumers. So idea is focusing on these products, which today may be 3-4% of our business. If we can take the 3-4% to a double digit, that is the endeavor to improve the premiumization. And anyway, the market is moving towards more value creation, so lower viscosity grades. So, there are grades like 0W30, which are big in the car segment, where we have got low market share. So this is what we mean by going towards better mix and premiumization.
Okay, thank you. And another thing is, just want to understand, are there any adjacencies to your business which you can look at for growth? So in, say, lubricant, coolant or whatever it is. So are there any adjacencies which can be looked at for growth?
Yeah, so for us, AdBlue is a big adjacency, which you have seen. We have made a success of it. We are in the top 3. And Manish, you want to comment on other? We also have a few motorcycle products we are bringing in. And of course, I think for us, getting into the EV space is where we can use our brand distribution and our network and our business relations. So really, these are adjacencies where we believe we can use our strengths.
Oh, okay. Thanks. That's it from my side. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. Our next question is from the line of Sabri Hazarika from MK Global. Please go ahead, sir.
Yeah, good afternoon, sir, and congratulations on a good set of numbers. So I just wanted to have a view on. So overall, your margin guidance for the next few quarters and for few years could be it's the same 12 to 16% range, or do you think that it could go up considering that we have got a benign oil and base oil environment and overall demand looking good enough for the sector?
Yeah. Thanks, Sabri. I think we have been talking about it in many of the questions that we guided a band of 12 to 14%, and we are now almost towards the upper end of that band. And if we actually exclude some of the overall AdBlue and all, which has also impacted the overall margin from percentage point of view, although adding to the overall kitty, we are already, above 14% in terms of core lube margins, if we say really. And our efforts on premiumization continues. Our operating leverage also will help. And benign input cost, as you rightly mentioned, definitely are going to be a positive. So overall, yes, we are looking at, not only continuing to be intact in this band of 12 to 14%, obviously with every opportunity we would like to take the band higher.
Right, sir. And second question is regarding your dividends. I think the policy remains the same, right? So because you don't have any major capex also lined up, so the payout and all will be similar to what has been the case so far, right? Or are you thinking about giving more cash back to the shareholders?
So you see, we this has been extremely strong 9 months period, YTD 9 month performance, and considering that only the board has been, board has announced already 16 rupee dividend against the last full year 25 rupee for the full year final dividend. So yes, the trajectory not only continues, but obviously we have been slightly, moving up on that chain, and certainly, as we do not have significant capex coming up in our core lubricant business, we have already done some investments in the EV, and we continue to generate cash. One of the key objectives is obviously to return cash to shareholders. So 16 rupee dividend, interim dividend is in line with that in terms of returning excess cash to shareholders.
Right, sir. So that's all. I think we've come to the end of this session. And thank you so much for this call. And before we hang up, any closing comments?
Ravi, you want to do, or?
Can you hear me?
Yeah.
Yeah. So I would like to thank everybody, and of course, as we have been, discussing over this call, our focus is remaining to, achieve both revenue growth and surpass the market trend by 2 to 3x, along with margin management. Our Q3 volumes also have clocked a similar trajectory of 2 to 3x. Of course, we have seen moderation in input cost and sequential improvement in gross margin, which is quite visible. EBITDA has improved sequentially, and it's also, our endeavor to invest in the brand, which we are doing with a lot of campaigns. We have had a number of campaigns which have gone on last 4 to 6 months. And we are confident that we'll continue our market-leading growth and gain market share with continuous focus on margin management, better product mix, marketing initiatives. Also, I think we are looking at segments where we have less than 5% market share, like industrial, passenger cars, and a series of new products are coming in. New, SUV oil has been launched, and definitely grow more in these segments and in geographies also where we have lesser market share. And further, we keep evaluating investments in e-mobility. Definitely with Tyrex and Electricity and Indra, we look how we can, bring this to the market more in terms of getting more market share here. And also look at the synergies that these businesses can get from our current business in terms of our brand distribution and our partnerships to ensure that we get sustained and meaningful growth in these also. So that's all from my side. And again, thank you very much for all your time, everybody, and look forward to catching up in the next quarter. Thank you.
Thank you.
Thank you. On behalf of